Okay, class. Good evening, everyone. So we have to start our class now. So last week we started looking at ratio analysis, and we used the past question approach. We solved last diet question on Oracle Limited, and I taught you that when you're faced with most of these exam questions, that the first is to look at the requirements of the question. For this diet, the question required you to compute 12 ratios, all these ratios here, and also to analyze the position and performance of Oracle Limited for the period and determine if Datamatics investment in Oracle will be worthwhile. So apparently, Datamatics is considering investment in Oracle. So on the basis of the analysis of the ratios computed in A above, then you would be able to make such assertion that the investment of Datamatics in Oracle will be worthwhile. And before we solve the question, I told you that when it comes to ratios generally, that there are 5 classes of ratios. There is profitability ratios, there is efficiency ratios, there is liquidity ratios, there is solvency ratios. So with the question that we solved, it has helped us to look at major elements of these ratios, but there are few that we haven't considered. One of it is solvency ratio. We have not looked at the entirety of it, and also is investors ratio. So we cannot lose sight of those ones as well. So we need to look at them. However, before we would come back to that, I would want us to solve the second question of last diet question, which was also on ratio analysis. Then we would then look at any other ratios that I have not mentioned. I'll quickly mention it to you. Then we'll look at the next thing on our plate for us to do for tonight. So now, in that question, it asks us to compute like 12 ratios, like I've mentioned, from gross profit to capital employed ratio, which is a profitability ratio, and computed it as gross profit over capital employed, to pre-tax profit to capital employed, to gross profit margin, to net profit margin, to non-current asset turnover, to receivables collection period, to payables payment period, to inventory turnover period, and also a logical ratio called revenue per employee, right? They give you the number of employees, and as well as, of course, with the revenue of the company, you can ascertain the revenue per employee. Also is dividend cover as well, and also current ratio and quick ratio. Then, having computed those ratios, they give us some industry average, which we can compare those ratios with. Then that would be useful in your analysis when you're analyzing the performance and position of the company. But ultimately, these 12 ratios will have earned you, like around 12 marks. Then when we analyzed it, the approach we used was to pick those ratios we computed one by one, and we made very simplified, a very simple comment on them. A very simple comment on them. Like for the gross profit to capital employed, we said we mentioned what the company is doing, which is 99.7%. We said it is impressive. And we said that it shows that the company makes huge gross profit on the capital invested by the owners. That was our analysis. This, we have showed the examiner that we have good understanding of this ratio, and we told the examiner what this ratio means, because it means the amount of gross profit made on capital invested. We use the same approach for pre-tax profit to capital employed. We said, I mean, compared to 99.7%, we said this one is low when you compare it to 99, where it's coming from. But we said that we then went ahead with our analysis that a 17.9 ratio shows that the company makes a 17.9 pre-tax profits on capital invested by owners. And we said the relative low ratio can be attributed to huge overheads and finance costs. A simple analysis. No. Then we moved on to gross profit margin of 43%. We said this is impressive. And it shows that the company makes 43% gross profit on every sales. That's my analysis. I made the examiner know that I know the meaning, and I showed them what 43% represent. If they had given me industry average on gross profit margin, I'll probably be comparing it with industry average to use that as a basis for whether it's okay or whether it is bad. Now, this net profit margin of 5.4%, you see, I could easily compare it with the tax margin of the industry because they gave me that one. And I can see that his own ratio is higher than it. And I mentioned that simply. I told the examiner that this shows that the company makes more net profit on every sales than other companies within the industry. Simple. For the non-current asset turnover, which you have for 2.7 times, I said it looks okay. Then I showed the examiner. I said, this shows that the company is able to convert its non-current asset to sales 2.75 times. The examiner will just be ticking for you. Will just be ticking because you will be very clear. Then I went to receivables collection period of 22 days. I said, they gave me that of industry. And I said, it is better than that of industry of 78 days. And I said, this shows that the company is able to recover its money from customers earlier than most companies within the industry. I said, the payables payment period of 64 days is longer than the industry average of 34 days. And I said, this shows that the company is taking a longer time to settle its suppliers because it might be facing liquidity issues, which is also confirmed by its low quick ratio of 0.7 ratio 1. Of course, at this point, you might not have computed. It was when I computed this, we're able to update this one. Because this really confirmed why is it taking him so long. Because if his liquidity ratio was strong, it will not take a long time before he settles his payables. We went to inventory turnover period. We said 61 days is long. It looks long. And this shows that it takes the company 61 days before it can sell its inventories. You see, this also shows why it's taking him so long to pay his payables. Because it's only after he has sold that he can pay. So if it's taking him 61 days to sell, I mean, it will take him longer to pay or settle his supplier. So, I mean, we can even mention that here if we want to. Also is the revenue per employee. You see, he is doing 4 million revenue per employee. Industry is doing 2 million. I mean, it's better. It shows that the productivity of the company's employee is higher than most companies within the industry. They also gave us dividend cover of 2 times, which shows that the company can pay its dividend from its profits 2 times. The current ratio also was given. You see, The approach to analysis is I will want you to really learn this and follow that approach on any question when they ask you to do analysis. Mention the ratio, tell the examiner whether it's good or not. If you are comparing it with industry, look at it. Your ability to say, okay, this is better than industry, this is not better than industry, shows that you know the meaning. Then that would be your first sentence. In your second sentence, then you'll be telling the examiner what the ratio means. What does it really mean? Which is what I'm doing, right? Like in this one, I said this shows that the company can only cover its current liabilities from its current assets, the ratio of 1.7 ratio 1. The quick ratio of 0.7 to 1, I said, is lower than the standard 1 to 1. And this shows that the company cannot effectively cover its current liabilities from its available liquid funds. Then I've analyzed all the ratios, and I need to do some conclusions. I said, following from the above ratios, ORAC Nigeria Limited is profitable from the standpoint of gross profits, pre-tax profit, and profit for the year. The company is also efficient considering receivable collection period, but its liquidity issue makes it it makes it take longer to settle its suppliers. The liquidity issue might be partly be as a result of slow, exactly, yeah, because it takes him 61 days to sell, as it takes the company 61 days to sell. So if Datamatics can invest cash flows into ORAC, it can improve the liquidity position and efficiency of the company, thereby making it a viable investment decision. We therefore advise that Matrix, we therefore advise that Matrix should invest in ORAC. And yeah, that's the end of that question. Another one, which was also last diet, was this question 5. I believe you can see my screen clearly. Was this question 5 last diet as well? Now, this one says that is in 2 parts. It's section C. They are always 15 marks. It says the IASB framework states that several measurement bases are used for the elements in financial statements. Then I said, explain the following bases. Historical costs, says current costs or current value, realizable or settlement value, and also present value. 4 marks, so 1 mark each. This should not even take you so long. So historical cost is the amount at which an asset is acquired or purchased, or the amount at which a liability was originated. While current cost or current value is the amount at which an asset or liability is purchased or originated, and which is constantly updated to reflect current reality in the economy, like inflation and interest rates. Realizable value or settlement value is the amount at which an asset can be sold, or amount that will be received when an asset is sold, or the amount at which a liability is repaid or settled. While present value is the discounted future value using a discount rate. Is a discounted future, is the discounted is the discounted future cash flows, okay, using available discount rate, right? That's present value, and it's synonymous to value in use. That's for 4 marks. Then the B parts, I mean, this is the first time I will see a question like this from ICAN, because looking at the question, if I go to the requirements, they say that you are required to prepare statement of financial position as at December 31st, 2022, 7 marks. Also, statement of profit or loss For the year ended December 31st, 2022, 4 marks. So looking at the information given, they said the following information was extracted from the statement of financial position of Wadai PLC, a company newly quoted on the Nigerian Exchange Limited. So we're given the total non-current assets as at December 31st, 2022 as 50,000. We're also given the closing inventory as at December 31st, 2022 as 5,000. We're now told that a financial analyst interested in investing in the company computed the following ratios in respect of the company for the year ended December 31st, 2022. We're given gross profit margin, net profit margin, inventory turnover ratio, net profit or equity ratio, equity to total current liabilities, non-current assets to equity ratio, non-current assets to total current asset ratio. So apparently, the examiner wants you to compute the financials using ratios. Okay, so this was the first time they asked it, and I mean, it's okay, but normally an average student should be able to get 11 marks, 11 out of 11, because from the ratios, you can easily get your figures. So let's look at the ratios one by one and see how we can get the absolute figures for us to then prepare our statements. Now, knowing fully well that they gave me two items here. They gave me non-current assets of 50,000. They gave me closing inventory of 5,000. Now, given that information, how can I then use that to get my relevant ratios, to get my relevant figures that I need? So the first one that I can see here that non-current assets can help with is gross profit margin. No, it cannot help. I have net profit margin. No. Inventory turnover ratio of 10 times. This one can help if I decide to use inventory as my closing inventory. Net profit to equity ratio, would that help? No. Equity to current liabilities ratio, then non-current asset to equity. So we can start from here, or we can start from non-current asset to total current assets. So either of the two, I can start from here because they gave me my non-current assets. So let me start with that. So they gave me non-current assets to equity ratio. The examiner gave me as 5 to 7, a bit 5 to 4. And I know that you know that 5 to 4 means 5 all over 4. So knowing that, let me move to the next page. Knowing that my non-current asset given to me from here is 50,000. My total non-current asset from here is 50,000. Then 50,000 divided by my equity. I don't have equity yet. Equal 5 divided by 4. So I have only one unknown here. So that means my problem is solved. Then Then from here, if I cross multiply, I will have five equity equal to 200,000. Then my equity will be 200,000 divided by 4. Then my equity will be how much? What's 200,000 divided by 4? Is that 40 or 50,000?
Divide by 5.
Yeah, divided by 5.
Divide by 5.
Okay, divided by 5. Okay, so that's how
40,000.
much? That should be 4,000. So that means I've solved for my equity. So let me show this as, let me say workings. So this is workings 1. Now that I've gotten my equity, I can just start getting every other one. Let me quickly get my total non-current assets. I can also get my total non-current assets using this approach as well. So I was given my non-current assets, non-current assets to current assets. I was given that as what? 5 to 7. And 5 to 7 is 5 divided by 7. Knowing that my total non-current asset is 50,000, and my total current assets is unknown, equal to 5 divided by 7. Then my current assets will simply be 350,000 divided by 5.
Yes.
So what's my current assets?
70,000.
70,000. So I've gotten my current assets. So I can move up. I can get my current liabilities also, because I was given equity to current liabilities to be 50%. So workings 3, equity to current liabilities is 50%. I can say 0.5. That's 50%. And having gotten my equity up there to be 40,000 from workings 1, divided by my current liabilities equals 0.5. Then from here, my current liabilities, see if I cross multiply, okay, I'll be having, let me see, let me make it simple for you. It's 0.5 current liabilities equal to 40,000. If I divide 2 by 0.5, my current liabilities equals 40,000 divided by 0.5. So what's my current liabilities? Can you press your
80
calculator?
80,000.
That will be 80,000. Then having gotten that, I can also trickle up to easily get my net profit, given that my net profit to equity was given as 20%. So my net profit divided by equity equal to 0.2. My net profit is the unknown. I know my equity to be 40,000 from my computation above, equal to 0.2. If I cross multiply, my net profit will be 0.2 times 40,000. So what's my net profit? That should be 8,000, right? Is that correct? Anybody?
Yes.
Okay. Then having gotten that, I can then move up a little bit also to, let me still leave this inventory turnover ratio. Let me go to my net profit margin. Let me go to my net profit margin. So my net profit margin, because I have net profit, I don't have margin, is 20%. So my net profit margin is net profit over sales. Abi? Equal to what? So was it 20%?
20.
Yes, 20%. So I have my net profit already to be how much? I have my net profit to be 8,000, right? So equal to 0.2 into bracket sales. If I divide through by 0.2, my sales will be 8,000. 8,000 divided by 0.2. So can you give me the figure? So much
40,000.
my sales is 40,000. Then number 6, I was giving my gross profit margin be how many percent? 25%. That's 0.25. So I don't have my gross profits, but I have my sales to be 40,000 for 2.25. My gross profit is simply 0.25 divided by 40,000, multiplied by 40,000. So what's my gross profit? How much is that?
10,000. 10,000.
Simply 10,000. Okay. So by implication, I've solved for everything except that I don't have my cost of sales. But I can easily get my cost of sales. I can easily get my cost of sales because I have sales, I have gross profit. So, but I mean, if I have some time in my hand, I can just, because the examiner already gave me closing inventory. Okay. And I've gotten everything. I can easily get my cost of sales. But let me just show some skills and break down this inventory turnover period. Let me use average inventory. Okay, let me use average inventory so that I can get opening and closing inventory because I have opening, I have closing, I can get opening. Okay. And when I get opening, I can get purchases so that I can have a robust statement of profit or loss. So if there is any mark, though it's 4 marks, in the exam, I might not do this, but I mean, let me just show you. So inventory turnover ratio of 10 times. Let's look at that. And what's the formula for inventory turnover ratio? Let's use average inventory. Though I advise that you should always use closing, so let's still stick to that advice, but because this is a special question that requires work back, so let's explore a little bit. We said equal to 10 times, right? So my average inventory is my opening inventory plus my closing inventory divided by 2. So we're good with mathematics. You know that automatically that divided by 2 becomes, it will come under here, right? And fortunately, sales is also there, Abby. Sales is also there with it. So equal to 10. Now, I don't know my opening inventory, right? But the question gave us closing inventory. They gave me closing inventory here as 5,000. They gave us closing inventory as 5,000 divided by 2 multiplied by sales. And we have gotten our sales before as 40,000. Equal to 10. So if I do, let me just do it step by step for you. My opening inventory plus 5,000 equals 10 times, this 2 times 40,000, 80,000 can then come to this side, all right? So my opening inventory no, there's something wrong. Okay, I used the wrong formula. Inventory turnover ratio is 10 times. So I used inventory turnover period. That's the formula that I used there. This is the formula for inventory turnover period. So if that's the case, they cannot give me this as 10 times. They'll probably give me this as 10 days. So inventory turnover ratio in that case will be the reciprocal of this, okay? Which should be sales over that average inventory, okay? So that means our sales will be up here. While this will then come right here. Equal to 10. So in this case now, divided by 2. So everything will change. Okay. So this is like opening inventory divided by closing inventory divided by 2. what would that become? For simplicity for you, this divided by 2, let me make it, ordinarily it should become sales multiplied by 2 divided by that, but let's make it a little easier. And this can become opening inventory divided by 2 plus our closing inventory given us as 5,000 divided by 2. Let's see if that will be easier. Then this gives us 10. Our sales being 40,000. I think these are pretty bit difficult. Let me see. So my opening inventory divided by 2 plus 2,500 equals 10. So if you cross multiply, we have 40,000 to bracket 10. We have opening inventory divided by 2 plus 5,000 to 5. So 40,000 equal to, if I multiply 10 by this one and 10 by this as well, then I will have, because 2 will cancel 5, that would be 5 into opening inventory plus, if I do 10 times that, that will be 25,000. Then I will then have 40,000 minus 25,000 equals, then this becomes, what's 40 minus 25,000? That's 15,000, Abby.
Yes.
Then what's my opening inventory?
3,000.
So I'm dividing 2 by 5. That's 3,000. Okay. So instead of all this, I mean, it depends on how good you are with mathematics, really. You could have solved this in varieties of ways. So from here, if that 2 should go up, and this becomes 80,000, right? Straight on. And this we have 5,000. Anyway, it's still a long process also. So you can check it and to give you. So with this now, I've gotten everything I need to get. Then I can prepare my statements. Let me start with statement of financial position. Statement of financial position, because that was required first. As at year ended, which period now? 31st December 2022. For which company? Wadai PLC. As at 31st December 2022 for Wadai PLC. Okay, so under my assets, I was given non-current assets. And the non-current asset given was 50,000, right? Non-current asset was 50K from the question here. And also, I was given my current asset, but let me break it down because this, I was given closing inventory as 5,000. Then other current assets, since I've gotten my total current assets somewhere, yes, yeah, 70K. Then this can be 65,000. Okay. Then this 70,000. That means my total assets is how much? Is
160. 120.
120,000.
Mm.
Then my equity and liabilities. First, I start with my equity. I was given my equity as how much? I got it here as 40,000. We believe that this will be increased by net profits because if you're not paying dividend, all your net profits would be retained. So we have gotten our net profits somewhere as 8,000.
8,000.
As 8,000. Then my total equity then is 48,000. Then I don't have any non-current liabilities, but I have current liabilities. How much is my current liabilities?
Eighty. 80,000.
My current liabilities here is 80,000, which is 40,000 divided by 0.5. That's 80,000. Then my totals, my total equity and liabilities is, here is 128,000. Well, I've expected this to be equal, but it's not equalizing. There's no way I can confirm because I was not given like a trial balance that would know whether should balance. Okay, we don't have time for that. So let's go to the statement of profit or loss. Wadi PLC. Statement of profit or loss. For the year ended 31st December 2022. How much did we get our sales as? 40,000. Our cost of sales, I'm break that down because a lot of time to solve for this inventory of 3,000. I don't have purchases, but I have closing inventory as 5,000. So, and I know that from our workings, how much is our gross profit? 10,000, which means that ordinarily they expect our cost of sales, would expect our cost of sales to be 30,000. So, can you get me our purchases? Can you get the purchases?
That's the opening inventory plus purchases and exclusive again plus the cost of sale.
How much is that? If you cannot get this one, that means don't even try this question in the exam at all. So that means all of these ones you have been doing, you might not even be able to have achieved this. You cannot do this simple arithmetic. It's just simple arithmetic. So since we have only one unknown, so it's like 3,000 plus x minus 5,000 equals to 30,000. So if we do 3,000 plus x equals to 25,000, x will simply be 22,000. Sorry.
So I think X will be 32,000.
Yes, 32,000. Yeah. X will simply be 32,000. But this is also minus 2. That's 35. Okay. Yeah, 35. So what is my operating expenses? I don't know, but at least we know our net profits should be how much? I think 8,000. I think we got 8,000. So this will be how much now?
2,000.
1,000. Okay. Then, so let me make this one balance, right? So that ordinarily they have made a mistake in setting this question, but let me just allow it balance. I just wanted to. So ordinarily, the examiner, when they worked back, whatever, they assume that net profit is inside equity. And I don't know, that assumption is not so correct from them, because since you are just doing it for the year, and it's like what they are giving us is like we are getting back like a trial balance, but it's okay. Let's just remove this net profit, assuming that your net profit is already inside your equity, then this one would be balanced. But really don't really be bothered about balancing or no balancing in the exam, especially when you're faced with a question like this that you assume that you should balance. That's not what makes, even if I don't change it, I know if I leave it, I put equity, I put net profit, I will still get my 10 marks complete. I'm sure of that because I've shown my workings, I've done everything correctly, right? Then ordinarily they should have net profit there. So they have missed out something when they were modeling that question. But it's okay. You can always just to show students that it can actually go in balance. So this was what these guys were wanted you guys to do for how many marks? 11 marks. 11 marks. And they said the performance was average. Most students attempted it. They did this first part well, where they said it defined, but this one, as a student were unable to deduce most of these things like that. At least it's good that they have asked it now. So if it comes again, you should be able to calculate in your exams. Okay. So do you have any questions? Before I go to other issues that I feel that all of these questions haven't really touched. Do you have any questions? Okay, good. So now the other ratios that the questions we have solved has not been able to address, for the profitability ratios, see, we have learned quite a number of ratios and profitability ratios from those past questions we solved. You have learned gross profit to capital employed. You have learned net profit or pre-tax profit to capital employed. You have learned gross profit margin. You have learned net profit margin. You have learned what again? Yeah. So I think we have not touched return on capital employed. Return on capital employed. And from gross profit to capital employed and pre-tax profit to capital employed, I feel that you should be able to easily deduce this formula. And it's simply profits divided by capital employed. And I told you that for this capital employed, you can either use debt. In fact, you can either use just equity or you use equity plus debt. Now, sometimes the examiner will tell you what capital employed to use. But for profits, you can use gross profits as you have seen. They can use net profit as you have seen. They can use any of those profits. So if you are using gross profits or you're using operating profits, which is PBIT, you see, on no account should you make your capital employed be just equity alone. You'll be wrong. Make sure the capital employed you use is equity plus fixed, let me call it fixed interest debt. When I say fixed interest debt, I mean debt that you pay fixed interest on, like your loan notes or your debentures that you pay fixed interest on. Those are fixed interest debts. Of course, remember, multiply by 100 over 1. But if your profits you're using is net profit or profit for the year or profit capital employed as simply equity. Simply use it as equity. And the interpretation is very straightforward. It's just the amount of this one, the amount of gross profit or the amount of operating profit that is made on the capital invested. Same thing here too. The amount of net profit or the amount of profit for the year that is made on capital invested. I hope that is clear. Another ratio I feel we have not mentioned is cost of sales ratio. I think this question did not capture that. And cost of sales ratio is computed as cost of sales divided by sales multiplied by 100/1. And this ratio looks at the amount of sales that is the amount of cost of sales that is incurred on every sales that you make. The amount of cost of sales that is incurred on every sales that you make. So that goes to show that if you have a cost of sales ratio of, let's say, 20%, your cost of sales ratio is 20%, it automatically means that your gross profit margin be 80%. Again, if you have a cost of sales ratio of, let's say, 20%, it means that your gross profit margin will be 80%. Because gross profit is the amount of gross profit made on every sales. Cost of sales ratio is the amount of cost of sales made on every sales. Okay, I think those two are the ones we did not touch. And from this question, you could see that the examiner can come up with a lot of ratios. They can express it, however, like this net profit to equity ratio or equity to current liabilities ratio or non-current asset to equity ratios. So if they come up with those ratios, you can easily also come up with the formula because it is as expressed. So, I mean, they can even tell you expense to total expense ratio. They could specify a particular expense relative to total expense. Just put that expense all over the total expense. They will give you the figures, you use it, then you'll be able to move on. Another ratio that I feel that we haven't touched is that relating to solvency ratios. Because these solvency ratios looks at the ability of a company to continue to operate as a going concern, given its exposure to financial risk. So given the level of financial risk you have as a company, can you still continue to operate? And the most important solvency ratio is gearing ratio. Gearing ratio looks at the amount of debt and specifically fixed interest debt that is present in an entity's capital structure. So it's like fixed interest debt over fixed interest debt plus equity. Because multiplied by 100. This gearing ratio, fixed interest debt over fixed interest debt plus equity. So this ratio, a ratio of 50% and above shows that the company is highly geared and is seriously exposed to financial risk. So highly geared means that is using a lot of other people's money, debt, to fund his activities, and that's financial risk. And financial risk is the risk that you might be unable to pay the interest, which might result in probably liquidation of the company. That's financial risk. And also the risk that the interest you are paying might become too high, that is now going to affect your ability to pay dividends to your shareholders, which might also impact your share price, So that's gearing ratio. You can find it in the exam also being called leverage ratio. When you are leveraged, means you're able to use other people's resources to fund your operations, leverage ratio. So another one you can find is very similar to gearing ratio. Is the examiner can call it debt to equity ratio. And I'm sure you should be able to deduce this formula as simply your fixed interest debt divided by equity. Of course, multiply by 100/1. Another one you can also find is debt ratio. They could just call it debt ratio. And when you find debt ratio, I advise that you simply look at the proportion of debts to total debt that an entity uses or that it uses to fund its total assets. So this one, you are allowed to use your current and non-current liabilities, add them together, put them on your current and non-current assets, just to play around with debt and assets to see what proportion of your debts constitutes your assets. But for these other ones, we need you to use just the fixed interest debts, not just any debts. Don't go and be using provisions or deferred tax. No, we need you to be very specific regards the debt you can use. Another very popular one you will find is interest cover ratio. And this looks at the number of times an entity can pay its interest from its profits. So you find the formula as profits before interest and tax divided by your interests payable or paid, or your finance costs. So the answer you get will be number of times. To be the number of times your profits can pay your interests. That's your interest cover ratio. Okay, so these are solvency ratios that I feel that those questions I solved did not mention, and you can find them in your subsequent exams. Another class of ratio that we did not mention and is worth mentioning are investors' ratios. And the first and very popular one is dividend per share, which is dividend paid divided by number of ordinary shares ranking for dividend. I just needed to mention this ranking for dividend. It might not be mentioned like that in the exam. It might just give you the number of shares and you use it like that. But you need to know that it's really the number of ordinary shares ranking for dividend that we put as denominator here. Because it's not all shareholders that are ranking for dividend in a particular fiscal year or financial year. So some would buy the shares where the register is closed for payment of dividend, that they will only be due for dividend in the next financial year. But in this case, the exam might not necessarily need to go that deep. So that's dividend per share. Is the dividend paid divided by number of ordinary shares. So you'll be getting maybe 2 naira, 3 naira is expressed in naira. Another one is dividend yield. And this is a measure of effective dividend that is paid. And you'll be seeing it as dividend per share divided by market price. This is very strong, and I can multiply by 100/1. Because if you have two companies, where company A is doing, let's say company A is paying a dividend of 2 naira, and company B is paying a dividend of 5 naira. See, you might think that company B is better until you find out that to buy the shares of this company A is just 1 naira. So that means this guy is giving you 100%. But to buy the shares of this guy, it could be, let's say, 5 naira. This guy is giving you 200%. But this guy is giving you just 100% return. Because he gave you 2 naira dividend. And to buy that shares is just 1 naira. So times 2 is what you are getting. This one, dividend is 5 naira. To buy that shares is 5 naira. So it's giving you 1 to 100. Like that. So that's why this is a very important measure. Another one is earnings per share. And I'm aware that you have been taught this as a topic on its own. So majorly is profits attributable to ordinary shares divided by weighted average number of ordinary shares. That's your earnings per share. And I think that our past question has mentioned dividend cover. Solve the question that looks at dividend cover, which is number of times our profits can pay our dividend, profit for the year, divided by our dividend paid, as dividend cover. Another one is price earnings ratio. And we usually get this formula from the name of the ratio itself, which is price being market price divided by earnings being earnings per share. So this ratio looks at the market confidence in a company's ability to grow. The market confidence in a company's ability to grow, in the sense that if a company has a high PE ratio, it simply shows that the market believes that that company will grow in the future. Because having a high PE ratio would mean that your earnings has to be small and your market price is up there, is high. And that's contrasting, because if your earnings is small, we don't expect your market price to be high, right? It should be low. But when you see a company that has a small earnings and the market price is huge, it's going to make its PE ratio to be high. What that simply reflects is that even though this company is not making so much earnings now, but we believe in him, we'll still continue to invest. So the market price is like earnings multiples, that this earnings is going to multiply the future. That's why you see a company like, most of these tech companies having huge valuations. Some of these companies that are not even listed. Like, for example, now, most of you have heard of MoneyPoint, right? Yes, they're doing so well now. Even before they were doing so well, they are a unicorn. They are worth over $1 billion, right? Most of these banks, that you hear about, they don't worth $1 billion. They don't. Most of even our tier one bank, if you go and check their total assets. But the valuation of these new companies are worth over $1 billion. Look at Flutterwave. They are worth over $1 billion. But when you check their earnings with the earnings of these banks are making much more than them. Or a company like, let's say, let me go international, let's say Tesla, right? Is worth much, much more than companies like Toyota or Mercedes-Benz that makes huge sales, huge earnings. What it shows is that the market have confidence in these new companies, that they will grow, that they can scale much more than these conventional companies that have huge fixed costs and their revenue is just going steadily. That these ones, their revenue is going to multiply in the near future. So that's what price earnings ratio looks at. It's a special ratio and it's very relevant for analyzing startups, and most advantageous is those that are listed or that we can conveniently determine their valuation or whose valuation have been arrived at before. We can easily get their P ratio and see what it looks like. Another one is dividend payout ratio. And dividend payout ratio is the proportion of our earnings that we are paying as dividend, which is dividend paid divided by profit for the year. Then can multiply by 100. Another one also can be dividend retention ratio, which is the proportion of our dividend that we are retaining, which is mostly your profit for the year, proportion of our profits that we are retaining, so minus dividend paid, okay, divided by our profit for the year. All these places that I'm using a profit for the year, you can as well use EPS for them. Okay, so that is everything for ratios. Do you have any questions before we go to the second agenda for the day. So one thing I would really want you to read up is limitation of ratios. What are the limitation of ratio analysis? You'll find it in the handout. And also, you also meet limitation of maybe EPS. I've seen them ask it once or twice. Limitations of EPS. I would also send it as part of my assessment that I sent to you. Okay, so that's that for that. Do we have any question before we move to the next agenda for today? I thought you guys were going to be active today because today is public holiday, but
Okay,
I think
sir. Please, do we have any questions, like maybe like ICAN questions that we can work with these investors and ratios, solvency and investors?
yes, in your handouts, I've already collated all ICAN questions there with the solutions. So you can just walk through that. But ICAN don't really ask much on those investors ratio. They are always asking efficiency and liquidity and profitability for the most part of it. But you can look through these our handouts. I'm sure you would find one or two questions there for your practice. If you can't, let me know. I would definitely give you some further questions for you to practice on. But you have a lot of questions in that your handouts. Okay, so we are getting to the final lap of our class. And I think that after today's class, I would only have one more class with you, which is, except for the Thursday's classes, I think I have one more. The last one would be, what's today? Today is Friday. I'll have one more Thursday class with you, maybe one or two if I wish, because what I want to teach you now is what I teach as the final thing for the diet. And you guys are already on it already, which is questions on published financial statements. That's really the last thing where we are going to apply most of these standards that you have learned and to prepare accounts and all of that, which is what you should know ordinarily, but it's important. And the way I do it is just to solve your question one. It's always going to be your question one in the exam, like that. That's what you find there. So if you check your notes, I just added this in my own material. You will find this, and I will share this one with you because this solution is easier than the one you will find in the ICAN Finder. So I would advise you, most of the solution that you can find here, if you are not getting some understanding clear in the Finder, you can just check this my note and see if I had solved it. It's a little easier. So at least for all the question one, since the inception, since when they start asking question one as published, I have all the solution in your handout. So you can use that as your practice, solve everything you have in this handout, just to be ready for that question one. So apart from this publish, I would solve one today if we can. If we cannot finish it, we'll continue next week and solve another one next week also. Then what I have left with you, I want to teach you IAS 20 on government grants. And also, I would like to discuss ethics with you. Ethics. So those of you that are doing CSME audit, they should have taught you about that, but I just want us, because it's examinable. Last diet, it was there. It's mostly there for 10 marks, 7 marks, like that. And also blockchain technology, the technology behind cryptocurrency and all that. So it's also relevant for financial reporting as well. So I would just want to discuss 1 or 2 things around that with you, just to familiarize with you, to make you know that something like that exists and is in your syllabus. So those ones will not take me so much time to teach. Within 1 hour, I can teach you blockchain and ethics. Then I might also want to discuss a little thing, just few things on inventory, IS2, just some core principles. When there's a damaged inventory, how do you measure inventory, like that, those few things. Then with that, we'll have covered, I mean, assuming that Mr. Abiodun has also taught you his own part, it means that we have covered your syllabus 100%. So if you can go through all of that we have taught you, these notes that you have in front of you, go through it. There's no reason why you will not pass. You will definitely pass this exam. We'll talk more on that next week. I think continue with that. So this was last diet question. And that question required you to prepare a statement of profit or loss and other comprehensive income for the year ended March 31st, 2023 for 10 marks. It's also requested for statement of changes in equity for the year ended March 31st, 2023 for 6 marks. It's also requested for statement of financial position as at that date as well. This takes the chunk of the mark, and that's 30 marks. No, that's 14 marks. So the total is 30 marks, question 1. And they gave us a trial balance, which balanced. Okay, so definitely your statements should also balance if you're not making mistakes. And they give us some additional information. First additional information here says that the land and buildings were purchased 15 years ago, 15 years before the beginning of the period. The cost of the land was 350 million. No land and building have been purchased by Nkumbilo since that date. On April 1st, 2022, which is the beginning of the year, since the end of the year is March 31st, 2023, so that means April 4th, 2022 is the beginning of the year. Nkumbilo PLC had its land and building professionally valued at 400 million and 875 million, respectively. The directors wish to incorporate these values into the financial statements. The estimated life of the buildings was originally 50 years, and the remaining life has not changed as a result of the valuations. Okay, so this note 1 just giving us information around this land and building. This land and building here. They say they purchased it 15 years ago, and they give me the cost of the land. And they said at the beginning of the year, they revalued the land and the building. So the new revalued amounts are this. And they bought, the land, the building has 15 years, 50 years useful life. That means, and they bought it 15 years ago. So that means the remaining life should be around 35 years. So which hasn't changed as a result of the valuation. They now said later, the estate valuer, Messrs. Jasco and Company informed Concom below that investment properties of the type owned by Concom below PLC has increased in value by 7% at the end of the year. So they are speaking about this investment property here of 450, that the value has gone up by 7%. So all I just need to do is to increase this value by 7%, since that's what they are implying here, that similar assets have gone up by 7%. Also, say plant and machinery other than the least plan stated in note 2 below here is depreciated at 15% per annum using reducing balance method. Now say the position of building, plant and machinery is charged to cost of sales. Okay, so they are speaking about this plant and machinery here, that we should depreciate it at 15% using reducing balance method. Said on April 1st, 2022, Cocom Below PLC entered into a lease for an item of plant which had an estimated life of 5 years. The lease period is also 5 years. Annual rental is 110 million payable in advance from April 1st, 2022. The plant is expected to have a nil residual value at the end of its life. If purchased, the plant will have a cost of 460 million and be depreciated on a straight line basis. The interest rate implicit in the lease is 10%. Okay. So I've taught you leases. And by implication of that, you should be able to address this. Show you. Thirdly, they said the loan note was issued on July 1st, 2022 with interest payable 6 monthly in arrears. Said the provision of income tax for the year March 31st, 2023 has been estimated at 141.5 million. The deferred tax provision at the end of the year is to be adjusted to a credit balance of 70.5 million. The inventory as at March 2023 were valued at 260 million. Okay, so this is the question, and this is how it always comes every night. So, and you see, they give us additional information on the trial balance. And you see that this additional information is really speaking to items in this trial balance. It's speaking to probably end of the year adjustments that you need to be aware of, that you need to adjust, or transactions that happened newly that you need to incorporate in the books, which they haven't. So ideally, you're supposed to look at each of these items and then be able to adjust the trial balance with this additional information given to you, so that you have an updated figure, which you are then going to use to prepare your statements. Okay, so let me ask your opinion before I proceed with the solution. Of course, I have the solution which I'm going to share with you. So should I just explain to you, or we should just solve it together? What do you think? Anyone you wish to do?
Let's solve together.
Okay, Aisha. I need 2 more people to talk. I think I have like quite a number of here. Any other person?
So let's solve it together.
Okay.
It will make sense.
Okay. So let's do that then. So the first one, which is the land and building. This is speaking about land and building, that we bought it 15 years before the beginning of the period, 15 years ago, and the land is 350 million. So, and since that time, this guy hasn't bought any land till now. So at the beginning of this year, a valuer, the land and building was professionally valued. The land 400 million, the building 875 million. And that's because they told me that Kokum Below had its land and building professionally valued at this respectively. Since they said respectively, so that means this figure are in the order of this description. So land and building. So this 100 million is for land, while the 875 is for building. So yeah, the director wished to incorporate these values in their books. They don't even need to tell us this. We know that it has to be incorporated. It has to, except if they are not using evaluation model. Otherwise, it has to. The useful life of the building is 50 years, and the remaining life hasn't changed. Okay, so you always find something like this in your books. And when it comes to PPE, because land and building is property, plant, and equipment, in this case, there was revaluation. So that means you need to determine revaluation surplus or deficit first. And considering that this revaluation was done at the beginning of the year, aside doing evaluation, another thing that you also need to do is depreciation. You need to determine the depreciation. And also, when you have determined that, you can then determine the carrying amount of the land and building at the end of the year. Those are the three things you will commonly do in the exam. So by the time you solve more questions, you get used to that. So my workings first. Let me start with my land and building. So the first thing I will need to do that is relevant here is just the fact that they revalued the land and building. So, and like I taught you under year 16, as soon as the revaluation occurs, the relevant calculation is for us to determine revaluation surplus or deficits. So I'll come here and determine my revaluation surplus or deficits. So in millions, I have to make sure my solution is also expressed in millions. And how did I know? Because my trial balance is expressed in millions. So I need to express this too in that manner. So how do I get my revaluation surplus or deficits? I need to compare my revalued amount or fair value, revalued amount or fair value. And let me just add the two together. The land and building, the land is 400, this is 875. So what's 400 plus 875? How much is that? You have to bring out your calculator, guys. Sleep here. That's
1,275.
okay. You compare that with the carrying amount of that asset. And how do you get carrying amount? Is the cost of that item. And what's the cost of this item? You go to your trial balance. The land and building
One,
is 1,350. Abi?
one, yes,
1,350 minus accumulated what? Depreciation
depreciation.
at the beginning. You go to your trial balance. Under accumulated depreciation here, it was 300. So this gives me 300. So That will give me how much? 1050.
1,050.
Okay. So I can see that my revalued amount is higher than my carrying
Mm.
amount. So that
Mm.
means having a revaluation surplus
Surplus.
of how much?
225,000
225 million. Okay.
million.
So that's the first thing I will determine first. And I know that this will go to where? Other comprehensive income. Abi?
Income. Yes.
Yeah.
The second thing that I need to compute is my depreciation charged for the year. That's the next thing I will need to compute, my depreciation charge for the year. And when I want to do my depreciation charged for a revalued asset, it's simply going to be the revalued amount of fair value divided by what?
Number of years.
The remaining
Million.
useful life
Mm.
divided by the remaining useful life. In this case,
225.
the valued amount of these assets is how much?
225.
One
75.
1,125,000. I think.
No. See what I wrote on the board? 875.
Okay, it's for
Why am
property.
I-
For the building alone.
Exactly, for the building alone, because we
Mm.
don't
And
depreciate,
depreciate land.
land. Good.
Mm.
And from the question, the useful life of the building is 50 years, and we purchased it 15 years ago. That means the
Mm.
remaining life is how many years?
35.
35 years. So how much is the depreciation charged?
25
That's 25 million.
million.
So
Mm.
I know that this will go to my cost of sales. And how do I know that it's going to cost of sales? Because they told me here that, where is it? I saw it somewhere. That depreciation of building, plants, and machinery is charged to cost of sales. Now, for every PPE, lastly, you will need to determine the carrying amounts of the land and what? Building. And how do I get my carrying amount? For a revalued asset, is simply the revalued amount minus subsequent accumulated depreciation. If you still remember what I taught you. And my revalued amount up there was 1,275 for the land and building. My subsequent depreciation is 25. That means my carrying amount is how much? 1 to 50.
1,250 million. Mm.
Okay. And that's the first workings for this question. That's the first workings. Is that clear?
Yes.
Okay. You see, if not that this was at the valued amount, to get carrying amount, you know that it will have been the costs, which is this one 350 minus
Mm.
accumulated depreciation, which will have been 300 plus
Mm.
depreciation for the year. Okay, but if we solve more questions, more diets, we would see more dynamics. So let's go to I'm done with this. So the second one talks about valuation of investment property that increased by 7%. So all I just need to do is to increase this investment property of 450 by 7%. So, and I've taught you investment property. So we're looking at investment property. So what's the valuation of this investment property as at the beginning of the period? How much is it? Said it's 450, Abby.
Yes.
They said if value has increased, which becomes a fair value surplus, it has increased by 7%, so which will be 7% of 450. So how much is that?
31.5 million.
31.5 million. Okay. So if I add the two together, that gives me the valuation as at the end, which is how much?
481.
81.5. So that means this becomes the new value of that investment property. Where would this 31.5, where will it go?
It will go to P&L.
That's correct. As other income. You don't take it to OCI. Aisha, so why didn't you consider it as OCI?
Because it's an investment property. It goes to profits or loss.
That's absolutely correct. So fair value surplus on investment property go to profit or loss because they use an investment, a fair value model for their valuations, for their subsequent measurements. So that's all for that. Workings 3, I'm done with this. For this guy, say plant and machinery other than leased plants stated below is depreciated at 15% per annum using reducing balance method. Okay, that means the only thing that affects this is just for us to calculate our depreciation for the year. So given a value of 780, so plants and machinery now, I was given the costs as how much? 780. I will deduct accumulated depreciation since my depreciation will be completed using reducing balance method. The accumulated depreciation for this plant is how much? 130. So that means my carrying amount will be how much in this case? 650. Then that means my depreciation charge for the year using a depreciation rate of 15%. If it is reducing balance, it's going to be 15% on the reduced balance after deducting the depreciation from as at the beginning. If it had been straight line method, it would have been 15% on costs on 780. Okay. But since it's reducing balance, it will be on 650. So how much would that give us?
97.5.
97.5. So what is the carrying amount of this plant and machinery? Oh, 650,
552.
552 point what?
5.
0.5. Okay, so we are done with this. This one, you said the guy leased the plant. Leased the plant. The plant has 5 years. The lease period is 5 years. The lease rental is 110. And he pays this rent in advance. It's payable in advance every year. That's from 1st of April 2022. So the plant will have a new residual value. If they had purchased the plant, instead of leasing it, if they had decided to purchase it, they would have paid 460 million and it's depreciated on a straight line basis. Interest rate increasing in the lease is 10%. So what do we do here now? What do we do here now? What are we going to do? Okay, no time, so let me just tell you.
The discount to present value is already discounted.
Yes, but I mean, beyond that, you need to know that we are the lessee now, and I taught you that the lessee must recognize a lease liability and a right of use assets whenever he rents whenever he rents an item. See, if you look at your trial balance, the examiner actually puts the rent that they paid for the first year, the rent they paid in advance is there. So you find students putting this as an expense. That would be very wrong. Because, like I taught you under FRS 16, when you lease an asset as a lessee, you recognize a lease liability and a right of use asset. So, and I taught you that at commencement date, you would measure that lease liability at PV of what? Of unpaid lease rentals. I told you that in most cases, the examiner will give you the present value, but unfortunately, in this case, they didn't give you the present value. So it will be the annual rent of 110,000 multiplied by the annuity factor of this 10%. Because they gave us the interest rate implicit in the lease as 10%. So can you get me the annuity factor? Do you know the formula?
Yes, sir.
Please get me the figure. You don't have to write the formula down in the exam at all. I'm waiting. Taking longer than usual. Taking longer.
0.34.
So
0.34.
what is wrong though? You don't know how to calculate it. 1 minus 1 plus R
0.1.
raised to power minus 4 in this case, because divided by divided by R. So if you point your calculator, since the R is 10%, and why I'm using -4, ordinarily should have been -5. But since the first payment has already been paid in advance, so that means it's remaining 4 payments that we need to discount to present value. That's why this becomes 4. So it's going to be 1.1. You can be pressing your calculator. 1.1 raised to power -4. You do equals. You get your answer. You then do 1 minus answer. You do equals. You then do divided by 0.1. So whatever you then get. How much?
3.16.
3.16. That looks correct. Then multiply that by 110,000. What do we have?
348685.
348685.
8685.
Okay, let's say 348.7. Since it's already in millions, so 110. 110. Okay, so I've gotten my PV of lease rentals at the commencement dates. So at the end of the year, like I told you we're just going to do a schedule, if you remember, where you do balance brought forward. Do balance brought forward, which is 348.7. Now, since the rent is paid in advance, you do lease rentals. In year 1, to be 0, if you remember, I taught you this. Then the balance becomes 348.7. Now you can apply your finance costs at 10%. So if you do 10% of this, that should be 34.8. Then you add this together. This will give you your balance carried forward, which is the value as at 31st March 2023. So can you add this, please?
383.57.
383.5.
5.5.
383, Abby?
383.5.
Okay. Then you cannot just ordinarily, this should end it. But if you stop there, you'll be wrong. You have to do the second year also, because when it comes to lease liability, you will need to separate the liability into current and non-current. This liability has to be separated. And the way I taught you, you will need the second year liability for you to do that split. So let me just continue. Let me do the lease rentals, which is 110 million. What will be the balance here? How much?
273.3.
273.5. Then my finance costs at 10%.
27.3.
Okay. So what's my balance carried forward? Which is the balance as at 31st March 2024. So how much is that?
300.8. 300.8.
100.
300.8. Okay. Yeah. So I'm done with my lease liability. Okay, sorry. Now let's go to right of use assets. Right of use assets. At commencement dates, the right of use assets is the PV of unpaid lease rentals as computed above, which is the 348.7, just like you have computed at commencement, this one that we computed here. Then you add amounts paid at commencement dates. And how much did you pay at commencement dates? 410 million. If you add the two together, it gives you the cost of the right of use assets, which is 458.7, right? And at the end of the year, all you do is to determine depreciation per annum first. And your depreciation is the cost divided by the lease term. And the cost in this case is 458.7. The lease term is 5 years. Can you punch your calculator and get me my figure?
91.7.
91.
91.7. So my carrying amount is the cost, which is 458.7 minus accumulated depreciation of 91.7. So how much is that?
367.
367. Okay, now I'm done with that workings. See, this is not outside of what you should know, except if you have forgotten. I have taught you all of this. So this is just it being applied here. So that's the end of this. Now, loan notes was issued on July 1st, 2022 with interest payable 6 months in arrears. Okay, so which means that they pay interest half yearly, 6 months in arrears. So you wait to the end of 6 months, then they will pay you your interest. You will wait again till another 6 months, then they pay your interest. That's in arrears. So they pay you, they owe you for 6 months, they pay you. They owe you for 6 months, they pay you. So that's how this guy, extremely straightforward. So in this case now, to deal with this, as far as this loan note is concerned, that means that's my note what? That should be note 5. As far as this loan is concerned, the only thing I need to adjust is the interest on loan notes, because the loan note itself, the value will not change. The value is not changing because, like I've taught you, we don't have any effective interest rates. If they had given me effective interest rates, then I will have applied that amortization table. You'll find another question like that in another diet where they will give you effective interest rate. In that wise, the value of the loan notes will change, because you need to get the amortized cost of that loan. And using that table I taught you, where you add the interest payable, deduct the interest paid, get a balance like that. But in this case, that will not fly. The value of the loan remain the value of the loan. Nothing is touching it. The only thing I need to be careful that you get right is just the interest on loan notes, and majority of students are going to get this wrong. Why? Because most of them we just look at the loan interest paid here, and that's what they will use as the amount that goes to P&L, which is extremely wrong. It's not the loan interest paid that goes to P&L. It's the loan interest due. Loan interest that is due on that loan that goes to P&L. And if you look at this loan note, it was issued in July. And looking at the year end being March, that means these guys are supposed to pay, as far as this year is concerned, they're supposed to pay 9 months interest. 9 months interest, because this loan was issued in July. If you count your hands, July to December already is 6 months. Then enter from January to March, that's already another 3 months, making 9 months. So we will need to accrue for 9 months interest. And it is that 9 months interest that would go to P&L. So the interest due on loan notes is the loan note. What's the interest rate on it? What's the nominal interest rate? Is 8%. You find it, they always write it beside it. Is 8%. So, and what's the principal value? Is 250. Okay, so we do 8% times 250 times 9/12. So what would that give us?
15.
How much?
15.
15. Now, this is the interest due. Then, how much interest did we pay? Interest paid from the trial balance was 10. What's the interest payable? Is 5. You see, is this 15 that goes as finance costs in my statement of profit or loss? This 5 goes as accrued interest in my statement of financial position. Accrued interest in my statement of financial position, I'll put it under current liabilities.
Current liability.
You have to be an expert in treating this, because you always find it in the exam. Is it that they bring out this? This one is always there, stable. You need to be able to combine that figure you have in the trial balance, which is always the interest paid, along with this one that you have to always compute yourself. The interest due, you have to always compute that yourself. And in most cases, it will be different from what you have in the trial balance. The interest you have in the trial balance is the interest paid. Then you get interest payable that you put as the liability. And that's all for this particular item. That's all for this particular item. So I'm done with this.
Can you explain again why we're operating with 9 months? I thought it's 6 months.
Because it was issued.
Hello?
Because it was issued in July. I think I mentioned it very clearly. It was issued in July and the year end is in March. So from July to March is 9 months. So the interest due on these loan notes is 9 months interest. Yes, they pay interest 6 months in arrears, which is that 10 million they have paid. So that one has nothing to do. So what is key that you need to be able to determine is how much interest is due for that year. Is 9 months interest. Okay. So they have paid just 10, which is what they are saying that, okay, they pay 6 months. That one is nothing. So 9 months interest, that's why I think I've answered your question. That's why we quoted it by 9 months. Because
Okay.
so the next one is the provisions for income tax for the year as 141.5 million. Okay. Time you have this, the immediate thing you need to go and do, because this 141.5 becomes your current tax. Now, I'm aware Mr. Biodo has taught you IS 12, or probably maybe you would do it. I'm sure you must have started discussions on it. So if you come to your trial balance, you should find current tax there. Luckily for you, it's not there. I won't say luckily for you because it makes your adjustments easier if it's not there. Because if it were to be there, then you need to know that if the current tax is on the debits, that is an under provision from last year. If your current tax is on the credits, that is an over provision from last year. And you will need to be able to adjust that against this estimate for the year. Okay, so hopefully you'll find a diet where you see that and where I will show you how it has been adjusted for. But for this diet, it was an easy process for you. Current tax was not in the trial balance, which shows that we didn't have any over provision or under provision for current tax from the previous year. All we just need to adjust for is the estimate of our tax for this year, which is 141.5. So I go to note 6, under my income tax, you know that I will have current tax, which is 141.5. So this 141.5, I have not paid it. One leg will go to P&L. The other leg will go to statement of financial position as a liability, as a current tax liability. So I don't need to put all of that. The second one is deferred tax at the end of the year. They said is a credit balance of 70.5 million. That's also straightforward. This one, you should always expect that they will give you deferred tax in the trial balance as well. If they don't give you, that means you assume it's zero. Okay. So the deferred tax in the trial balance was 62. And what that means is that is the deferred tax at the beginning of the year. It means that that's the deferred tax estimate at the beginning of the year. How do you put those together? So under my deferred tax, because that means there will be another workings here for deferred tax. So that means my deferred tax at the end of the year was 70.5. And my deferred tax at the beginning of the year, which is the figure in the trial balance, I think it was 62, right?
Yes.
Yes.
Okay. So it means that my deferred tax estimate has increased from beginning, increase in deferred tax by how much? Is this not 8.5? Is it 8.5?
Yes. No. Yes.
Yes. Now, this 8.5, okay, that's what will come in to P&L, goes to P&L to go and join this other current tax here as 8.5. While this 70.5 go in as current non-current liabilities under my statement of financial position. That means my total income tax expense that goes to my P&L was 141.5 plus 8.5. How much is it?
150.
150. And that's my income tax expense. You will always find this, but it might not always be like this. You need to understand how to combine all of these things together. This is not complete. So for the deferred tax, they will always give you the figure for the deferred tax in the trial balance, and also that of the one at the end of the year in the additional information. So you come to your workings and look at, has it increased or has it decreased? If deferred tax liability is increasing, okay, it means that's an income tax expense. If it had been a decrease in deferred tax liability, becomes an income. So you just come and deduct from here. Becomes an income. If your deferred tax liability is decreasing, but of course, if your liability decreases, that's an income. So you need to be able to establish that in the exam. Fully, when you look through some additional questions, you'll be able to see different dynamics that you can have. Okay, and that's all for the income tax. Then they give us closing inventory of 260 million. So, I mean, that means we treat our closing inventory is 216. And that's all for the workings. Now, before I go to my statements, there are some things I need to put together. Number one is my cost of sales. I need to work it out because I wasn't given like that. So the examiner wants me to compute it. So I will get my opening inventory from the trial balance. I was given the opening inventory as 189, and the purchases, let me put this, opening inventory as 189. Then my purchases, I was given as 391. I'm not sure I have any returns inward, returns outward or carriage inward. No, I don't have any of those here. But yeah, my purchases is 206, 391, I mean. Then my closing inventory, I think the additional information gave me as 216 million. This one, 260 million. So I can get my cost of sales to be how much? Can you add it together, please?
364 million.
Again?
364 million.
360.
364.
Okay, thank you very much. Then remember, I was told that depreciation should go to
Cost of sales.
cost of sales. So for the building, I think we computed our depreciation as 25. For the plant and machinery, and also for the right of use assets. Right of use assets. So let's go up there. For the building, yes, 25. For the plant and machinery, 97.5. And for the right of use, 91.7. Okay. So 97.5. And this is how much? 91.7. So how much is my cost of sales now?
578.2.
578.2. Another one that I will need to put together, I think, would be my finance costs. Because my finance cost, I have interest on loan notes that I computed above. This one that I said will go to P&L as 15. And I have lease interest that I computed when I was doing my liability. This one, 34.8. 34.8. So if I sum these two together, what will it give me? That's 43.8.
15 plus
That's what.
49.8. Okay.
Okay. So I feel that I'm done with my workings now. Then I can prepare my P&L for this company. What's the name of this company now? Cocoa Below PLC. Statements of profit or loss for the year ended 31st December 2023. So our revenue, how much is my revenue for my trial balance? That's 1392. 1392. Then my cost of sales for my working 7 is 578.2. That's working 7. Put it in jackets.
Gross profit.
So how much is my gross profit?
813.6.
813 point what?
8.
8.8. Then my other income and then commit. What are the other income I have here? I saw one here. There's this income from investment property that I have here.
27.
It goes into my other income. And also, there's this fair value surplus that goes into my other income. So technically, I can put a workings 9 and have other income, or you can just simply put them as separate line items. There's nothing wrong with that. You put them as separate line item in your statements. So fair value surplus on investment property. And how much was that fair value surplus again? On that investment property, 31.5. So I have 31.5. So if I should add these two together, I have 54.5 as my other income. So I go here, I have other income, and that is note what? Note 9.
9.
That's 54.5. Then I will check for my administrative and distribution expenses for my trial balance. And from what I'm seeing here, they did not give me admin and distribution, but the examiner decided to give me everything, called it operating expenses, and it says that it's 78. Good for me. So I go to my statement. I have operating expenses. I put it in jackets, and it's 78. So if I deduct that, I will get my profit before interest and tax, which is my operating profit. What are we going to get?
790.3.
790.3. Then I can deduct my finance costs, which I worked in working aids. Here, this 49.8 that I got here as my finance costs. So if I remove this one from that 790.3, I get my profit before tax. That's how much?
740.5.
Right.
Then I have my income tax expense, which I did for my working 6 here as 150. Working 6 is 150. So what do we have?
590.5.
590.
590 point what?
5.
5. Then I will have my other comprehensive income, where I will put my revaluation surplus
Surplus.
that I got from workings 1 of 25. You remember it?
Yeah.
It's 225. If I add this to the 590, I get something I call total comprehensive income. How much?
815.5.
Sorry?
815.
Okay. So I'm done with this. Then let me do my statement of changes in equity. For the year ended 31st March, I think it's 2023 or 2024. Then for that, I will have my share capital. I don't have share premium from the trial balance. I can see that. Then I have my retained earnings. I have my valuation surplus. Then total. Okay, so balance go forward. If I go to my car balance, my ordinary share capital was 750 from here. My retained earnings is 598. Okay. Can you add the two together, please? 750 plus 598.
148.
1,
348.
okay. Then I can put my total comprehensive income, which is broken into my profit for the year here. That will be added to my retained earnings and my
Visual surplus.
valuation surplus. If I add the two together, I get my 81.5. Then what is left is just, I saw a dividend paid
Then
from the trial balance, which I'm going to remove from here.
Five.
And how much was that dividend paid?
75.
Yes, 75. Dividend paid is 75. Moving it from here, when I come to the total, I'll remove it. So
ready to sleep. Okay.
let's add up. So the balance carried forward here is how much? 750. So what is 598 for plus 590.5 minus 75? How much is that?
1113.5.
3.5.
Like this.
Yes, 0.5.
Yes.
Okay, so what's the addition here?
$2088.5.
Okay. So that's my statement of changes in equity. Then I move to my statement of financial position. As that year ended at 1st March. You have your currency. You have your currency. So under my assets, non-current assets, I'll have firstly on land and building. I'm sure it's in workings one. If I go to workings one, I already did my carrying amount of 1,250 here. So just for me to pick the figure and come to put it here. Then also my plant and machinery, I believe is workings 3. Yeah, correct. Which is 552.5. I come here and insert it here. My investment property, leave is workings 2. Come here. Yes. 1.5. And insert it here. Finally, sure you can still hear me. Hello, class. Can you hear me?
Hear you. We can hear you.
Yes, we can hear you.
Okay. Finally is my right of use assets, which I believe is workings 4. Workings 4. And I already computed my carrying amount here as 367. Workings 4. 367. So those are my non-current assets. So can you sum it up for me?
Yes. 651.
Sorry,
2651.
okay, 651. Okay, so we'll move to our current assets. We'll move to our current assets. And what are the items that will constitute my current assets? I know I had one closing inventory. That will be first candidate that comes to mind. I think it was 216. Am I correct? Yes, 216. Also, trade receivables will be very handy. If I go to my trial balance,
266.
yeah, that was 266. That was 266. So which other item would have affected my current asset here?
Prepayable.
No, trade payables will not impact my current assets. Okay, can't find any other one.
Trade receivable.
No, we don't have rent receivable.
We have captured it.
Okay, let me add this 216 plus 266. That should be 482. Am I correct?
Yes.
Okay. So my total assets would be 482 plus 2651. How much is that?
3133.
Okay. So let's go to equity and liabilities. First, I will deal with my equity, which starts with my ordinary share capital. So I just go to my equity section and pick those figures from there, from here, for these ones. So 750. Retained earnings. Retained earnings is how much? 1113.5. Valuation surplus is 65. And we got them as how much? Total of 2088. 5, I guess. Yeah. The next one is my non-current liabilities. And from here, I have the 8% loan notes. So I told you the value will not change. Remains at 250. Then the deferred tax, which will got the ending balance at 70.5. I believe this was note 6. This one was in the question directly. It's 250. I hope you remember this 250. Where is it? Yeah, this one. Well, the deferred tax here, this one. I told you we'll go to non-current liabilities, which is the estimate of the deferred tax at the end of the year, 70.5. So aside those two, for my trial balance, I can't see any item that goes there as non-current here. The only item that should go as non-current should be my lease liability, right? And my lease liability at the end of the year is 383. However, from what I taught you in class, because some of these amounts will be paid next year, so we will need to split this 383.5 into current and non-current. And I told you that the liability of the next year after that is the non-current portion, while the difference between this 383 and this 300.8 is the current portion, which will be current liability. So let's take this as non-current first. If you had revised, this should not do you YY. If you have not revised, you definitely do you YY. Okay, these are the items of so can you sum these three together, please? 250 plus 70.5 plus 300.8. How much is that?
621.3.
621.3. Then my current liabilities, so I won't forget. Let me quickly deal with the lease liability I just explained. It should be, I know I'm deducting this one from, what's the figure again? Yeah, from this 383, which is the liability we are splitting, 383.5. So what's the difference?
82.7.
82.7. That comes in as my lease liability. Then let's not forget the accrued interest from, I think, working 7. Workings, where's the interest paid? Yeah, workings 5. This interest payable, 5. So workings 5. Interest payable 5. Okay, let's check the trial balance for other items. I know I'm going to have trade payables. Yes, there's trade payables, there's bank overdrafts. So 167.27, like that. So let's take them there. So we have trade payable, which is 167. There is bank overdraft of 27. Okay. Is there any other item that should go to current liabilities that we have not factored in? Yeah, there's current tax. This current tax should also be an item of current liabilities. Current tax payable, 141.5. Is there any other item of that we haven't factored in from our trial balance. We have touched every item here. We have touched every item here. Every item has been touched one way or the other. Okay. So let me take in this. So can you sum this? 82, this. Can you sum it?
423.2.
4.
23.2.
Okay. So can you add 423.2 plus 621.3? What do you have?
1044.5.
Can you add it to 2088.5?
3133. Balance.
Which is the same thing as that. So the total equity so in the exam, it's very rare for you to have a balanced statement of financial position. Is a bit rare. If you don't have a balanced position, it doesn't really mean anything. So don't start looking for why it did not balance. Even though if you remember the first question I solved with you, that's work back, that ratio that we worked back, you will notice that it didn't balance when I did it first.
Mm.
Yeah. And
Mm.
one thing you should have learned from my disposition was that I was not moved. I was not moved at all. I wanted you to learn something. So I could have decided to start looking for it. What should have happened? No, don't do that. Don't ever do that in the exam. Never, ever. Never, ever. There's nothing that makes students fail beyond that one. Because you start canceling, you start getting worried, don't ever do that. What I just did, I said I didn't balance. I just, okay, I expected this to balance, but it didn't balance. Then I moved forward to my next. I continue solving as if nothing has happened because I know I've done a lot. I've done a whole lot that will earn me all my marks. So not bothered. I just moved. Even if I've not done a lot and it's not, I'll move on. I just want to pass this exam and move forward. Then I then went back and adjust because I actually know why it's not balancing. I just wanted it to learn a character, the exam, that if it doesn't balance, don't get raw food, don't get bothered. It doesn't mean anything at all. If it balanced, then good. Good. If it doesn't, still good. Yeah. So this is what we are required to do in the exam. I mean, you are all here, we did it together. It seems so easy. I won't say it's difficult because I didn't see anything out of the ordinary here. It's just so easy. Everything I've taught you. There's nothing here that I have not taught you one way or the other. There's nothing new here. So it's really easy. It's just about putting things together and structure your solution however you want to and practice this because this is actually 30 marks. If you are good at it, you can start with it first. If you're not so good at it, then it's not advisable to start with it. Because if I multiply 30 marks times 1.8, 30 times 1.8, that's like 54 minutes. So you have 54 minutes to solve this. I think I started it around 9:10. Yeah, we've spent over an hour solving it together. Spent over an hour. So maybe if I was solving it on my own, maybe I would have spent maybe 40 minutes or thereabout. But I have to wait for you to call figures. I have to scroll. I have to read. I have to explain to you and do all of that. You spent quite a number of. Okay. So I think we have done well for tonight. We'll upload the videos, you can look at it. And the best for you is to resolve these questions yourself again and see if you can attempt it. So next week again, that'll be next week Sunday. Yes, next week Sunday. I'm going to be solving the next diet. I'm going to be solving November 2023 next week. Not only November 2023, I will solve November 2023 as well as May 2023. We're going to be solving 2 diets next week. So, and that will be the end of our Sunday classes. So next week Sunday will be the last Sunday class. So the remaining classes will just be just Thursday's classes. And that also is remaining 2. The one I'll have this Thursday and the one I'll have next week Thursday. And that will be the end of our ICAN journey. I will be doing an open revision classes for all ICAN students, not just network students alone. I would be solving some questions unpublished, and also I'll be picking some few standards. I'll be summarizing it, like 5 or 6 standard. I'll summarize it and I'll solve ICAN past questions on them. It's majorly be what I've taught you, my students, before. You can also join, it's going to be free. I'll make it open for all students. So for us, it's just a way to market our school so that they will know we have substance and we can make them pass. And you that you are our students, no matter how good we are, if you don't revise all of these things we are teaching you, you would not also pass. It's really if you revise it that your pass is guaranteed. Okay. Do you have any questions?
Yes, sir, I do.
Okay.
So, sir, for the list, I mean, for exam purpose, it doesn't really matter if you do not calculate for the entire list term, because I noticed you did for just 2 terms, the list payment.
Oh, yes, you don't have to calculate for the remaining periods. You won't need it. There's nothing I need them for. The only reason why I did for the second period is just so that I can split that list liability into current and non-current. Otherwise, that second year wouldn't have been necessary. Here you get.
Yes, sir.
Okay. I'll see you on Thursday. Bye.
Bye.